Hello, everybody.
Just for a little bit longer than me. Well, you know,
I know folks are still getting lunch
trimming it all the time.
and finding a seat, but I'm going to go ahead and get us started because we only have about an hour with our wonderful speaker today. I'm really excited to introduce or to reintroduce many of you, Dr. Natasha Pilkauskas. She's an associate professor of public policy at the Ford School down the street. And her research, which you'll hear about today, considers how demographic, social safety net, and economic changes in this country affect families and kids with low incomes in particular. So she's done a lot on multi-generational households and grandparents who live with their grandchildren and the ways that those households function, as well as the effect of policies like the child tax credit, which you're going to hear about today. And I just am so impressed with Natasha. Her work has been published all over the place. So just this year, she's got pieces coming out in the Annals of the American Academy of Political and Social Science, in Demography, in Milbank Quarterly, in several other places. It's a little intimidating. And more importantly, from the broader sense of the distribution of these important findings, just in 2023, her work has been featured in the New York Times, the Atlantic, the LA Times, and lots of other places. So you may have seen her in your travels already, and we're really lucky to have her to be speaking us this fall. So I'm just going to turn it over to you, Natasha. And thanks for coming straight from teaching. So this is double duty today.
Okay, good afternoon. Am I too loud or am I good? I'm kind of mic'd, kind of not mic'd. Yeah. I'm going to try my best to stay put. I like to wander. And so if I wander really far off, just flag me and send me back because I know that the Zoom is here. So I'm going to be talking about the child tax credit, which I will describe in a lot more detail soon, and the living arrangements. I kind of think in housing affordability or housing instability, kind of thinking about this as housing amongst low-income families. This is work with Kathy Mitchell-Moore, who I believe is on Zoom, so she can't take the hard questions for me, as well as Nicole Kovsky. And before I get started, I just want to thank Propel. They allowed us access to their data, and they also allowed us to add some questions to their survey, and I'll again talk about that more in a moment. I also want to thank the Charles and Lynn Schuster and Family Philanthropies, as well as the Washington Center for Equitable Growth, who helped fund our research. So today I'm talking about housing or housing affordability and living arrangements. I think we all kind of intuitively know that access to safe and stable housing is really important for adult and child well-being. And if you don't have a home, it's very hard to have a job, for instance. And then also kind of who is in that household matters for kids. So when we're thinking about child development and resources and what's available, we might be concerned who's there in terms of what that might actually do for children and child development. And so there have been declines in housing affordability over the last several decades, which has led to more housing instability. And in particular, low-income families face a lot of challenges in finding stable housing. And then what we're going to be looking at is during a piece of the pandemic, right? So the COVID-19 pandemic exacerbated housing affordability issues and kind of housing issues more generally. Now, there were policies, I'm sure you've heard about the eviction moratoria, which certainly reduced people kind of getting kicked out of their homes. But there's still a lot of people still owe that rent that they weren't paying, right? So they're going to still have to owe back owed rent and back owed debts. And in fact, some research shows that in 2020, about a quarter of families with earnings below $25,000 were behind on their rent. And this was more common amongst Black, Hispanic, and Asian renters as compared to white renters. And these are going to be the folks we're going to be studying today, is the below $25,000. So that's what I want you to have in mind when we're thinking about low-income families. And so kind of broadly, so if we're thinking about kind of unconditional cash transfers and housing, I think, again, we know from the literature overall that income is correlated with housing stability. The more income you have, the more stable housing you're likely to have. Some of my work with Kathy Mitchell-Moore, in particular, which is what motivated some of this research for us, our research interest, was that we found that the earned income tax credit, which is an unconditional cash transfer to lower income families, actually reduces doubling up, multi-generational households. It reduces household crowding, which isn't great for kids. And it also, it's good if it's reducing household crowding. Crowding is not great. And it also increases housing affordability. So sort of sitting in that, we were thinking, oh, we're kind of interested to see if we might see the same effects of the child tax credit. There's also studies from the Social Security literature that shows as Social Security was expanded over time, that it increases the likelihood of folks living kind of independently, so not being in a doubled up household. And then there's a new study that just came out that's a randomized controlled trial that actually also gave monthly income, which is going to be kind of similar to the folks that we're going to be studying. They gave monthly income over about a 9-month period. And what they found is those folks who got the cash were less likely to move out of, they were less likely to kind of have to move, essentially. So sort of sitting in here, we're going to try and kind of add to this literature. And there's also been some research on the child tax credit in particular. I'm sure you have all seen the news reports recently that are saying, you know, that with the expiration of the child tax credit, child poverty has, you know, gone right back up. I think there's a lot of studies that suggest that, I mean, it's mechanical, right? But like as people get more money, there's child poverty declines. But there's also studies that look at the child tax credit that find that it improves kind of economic well-being overall. People were more likely to have kept more cash on hand, which might then also, you know, reduce housing instability. If you have a question, like a clarifying question, I meant to say, please feel free to interrupt me. There are no studies that have looked at the impacts of the child tax credit on living arrangements. And then there's kind of 3 studies that have touched on anything actually at all about kind of housing affordability. There's 2 studies that look at whether or not people were able to pay their full rent or mortgage. They find no effects. And then there's one study that I think is probably the most similar to ours, which is that they're looking at whether or not you're caught up on rent. And that's in that study, they don't find any effects of the monthly transfer. They do find some effects of the lump sum part, which I'll talk about in a second. So what are we doing that's different from this prior work? We're going to really be focused on low-income families. As I'm going to show you in the next few slides, these are the folks that really benefit from the expansion. So they're not eligible for the child tax credit right now. During this brief expansion, they are eligible for the child tax credit. So we're going to be thinking about housing affordability in the following ways, because there's a million ways to define housing stability and affordability, of course. There's no consistency, but we're going to be doing it based on these measures because this is what we have in our data. So we're going to ask people whether or not they moved because they had difficulty affording their rent or mortgage. So we're going to try and see whether or not it affects that. We're also going to ask people how much they owe in back owed rent. So we're going to look at both the presence of back owed debt as well as the amount of back owed debt. And then we're going to look at living arrangements. So we're going to look at doubling up. So doubling up, I mean, we think about this from the child's perspective. It's having additional adults in the household that are not the nuclear family. So not their parent or their parent's partner. Now, some people might think that the cohabiting partner is a doubled up arrangement, but most of us who study doubling up don't actually include those partners as a doubled up arrangement. We think that it's different, right, in terms of why people might move in together. We are going to look at partners, though, in particular. Unfortunately, we can't distinguish partners who are cohabiting from those that are married. So that's going to be a limitation. We're going to look at the number of people in the household and whether or not they report changes. So just to give you a preview, what we're going to find is that the monthly child tax credit is going to reduce the likelihood that people have to move because they can't afford their rent or mortgage. It's going to reduce both the incidence and the amount of back owed rent. It's not going to affect doubling up, which is not what I had expected. But it is going to reduce the total number of people in the household, and that's going to be driven by partners being pushed out. We're also going to look at differences by race, ethnicity, and by earnings, in part because there are hugely differential impacts on these different groups with this expansion in terms of eligibility for the child tax credit, which I'll talk about in a second. So what is the child tax credit? If you haven't, I don't know, obsessed over this like I have, maybe you don't know all this history. It was implemented in 1997. There have been a number of changes to the credit over the years. It was really originally implemented as a tax credit to families with kids to help kind of defray the cost of raising children. Children are expensive. Just to give you a sense, in 2018, 39 million filers received the child tax credit at a cost of about $116 billion to the federal government. Today, so in 2017, we had a number of tax reforms that occurred. And so what this reformed the child tax credit, this is what it looks like now. So the child tax credit is a per child credit of $2,000. And $1,400 of that credit is refundable. So what is refundable means? It means you have zero liability, tax liability, and you can still get money back from the government, up to $1,400 kind of extra money in hand. There is an earnings minimum. You have to earn at least $2,500 in order to get it. There's also a phase-in, which I'm going to show you in a second. This is the current law. But in March of 2021, Congress passed the American Rescue Plan Act. They expanded the child tax credit temporarily. What did they do? They essentially created a child benefit. Child benefits are very common in European countries. They're just essentially a payment, a monthly payment to help pay for kids. We're basically doing that in the United States for the first time ever and only for 6 months. But what do? We basically take the credit that is currently $2,000 and we make it $3,600 for children under the age of 6. That's going to be $3,000 per child ages 6 to 17. So it's a big cash transfer. They're going to remove the earnings requirement. So you don't have a minimum earning. You can get this credit now if you do not work. This is going to be very different, right? It's fundamentally different than the current structure. It's made fully refundable. What does that mean? We're going to take out the phase-in. Essentially, you're going to be able to get the entire credit at 0 earnings. You get the whole lump sum, the whole amount of money without any earnings. And they're also going to basically make the payment structure such that you get a monthly credit for 6 months. So between July and December of 2021, there's going to be a monthly cash transfer going to all families with kids, or 90% of families with kids. And then that's half the payment, worth half the payment, and the other half is going to become at tax time. So when people file their taxes, they can get the other half of the tax credit. What does this mean? On average, people have 2 children. And so on average, they're going to get roughly $500 per month for that 6-month period. And some are going to get a little bit more if they have younger kids. So I think this is helpful, especially if you're familiar with the earned income tax credit. So the way the earned income tax credit is set up in many ways is akin to this, which is that you can see, so this is earnings. As earnings increase, you get more credit. So this is the current law. You can't really tell, but it starts at 2,500, this graph. And what happens is as your earnings increase, you become eligible to get more of the credit. This is how the structure that both the earned income tax credit and the child tax credit are. The idea is that it incentivizes work, right? So the more you earn, the bigger your kind of boost from work. And then that's up to 1,400, which is the refundable piece. And then it keeps going until you get to 2,000. But what you can see here is that you can't get the full refundability under the current law unless you earn at least $10,000. And then you don't get the full amount of the value of the credit, the $2,000 per child credit, unless you earn at least $25,000. So it is not a tax, it's not a transfer to low income families on average, right? It's actually going to much higher income families. In fact, this goes pretty far out in this income distribution. Now, the temporary expansion actually is going to basically take the shaded area. These folks are going to be able to get all of this extra cash. And these are folks that are just basically not getting the full credit typically, or currently getting the full credit. So the other thing is to realize is that this is not race neutral in terms of as a policy. The children who are left out of the current child tax credit, about 1/3 of the poorest children in the US actually don't get the full child tax credit. So there's 6 million children that are completely ineligible, but it disproportionately impacts Black and Latino children who are more likely to kind of be on sort of this piece of so Hispanic children in particular are more likely to be on the phase-in. Black children are more likely to actually not even be on this curve at all. And this is from estimates from my co-author on this paper, Kathy Mitchell-Moore. And then there's also other estimates that suggest that almost 11 million working families actually aren't eligible for the full credit, right? So when we're thinking about kind of these policies and thinking about kind of who's working and who's getting these credits, they're not getting all of the benefit of the current credit. So these are the families that are the focus of our study. And it's also a very great population that's really of interest to policymakers, right? There's lots of current concerns around sort of thinking about poverty and sort of in particular, its impacts on things like work. Okay, so yes.
I'm thinking about gaming this system. It's $2,500
to be eligible for a tiny credit.
That's $50 a week.
Yeah.
People have 3 kids. They presumably have neighbors. So they could child sit for each other. One do Saturday, one do Sunday. Pay $6.50 an hour for 8 hours. And they would, without actually changing their lives at all, they could appear to earn $2,500.
Yeah, but at $2,500, you're getting this much credit, nothing.
Okay.
There's a phase-in rate, right? So you basically have to earn $10,000 to even get the $1,400. Yeah, and you have to earn a full $25,000 to get $2,000 per kid. Yeah. Okay, so why do we think that the CTC would affect housing affordability? There's certainly work that shows that the economic well-being of families was improved. Families reported having more cash on hand. And even just descriptively, so some of my work with Kathy, we find that looking, we just ask people, what did you use the child tax credit for? And they say rent and bills. And this is pretty consistent across a lot of different studies that just ask people how they're using this money. And there's a new study that's a consumption study that uses consumer expenditure survey that essentially is looking at how people are expending the child tax credit. And they find first and foremost, they're spending it on housing. And then there's effects on other expenses as well. And then there's kind of a broader literature that shows that income is linked with housing affordability. I think at the most basic level, we think the child tax credit is making you better off, and you're gonna be able to afford your house. Now, what's maybe less clear is why we think that the child tax credit should affect doubling up, right? So here, this is living with extra adults beyond the parents. So I'm not sure which direction. I think intuitively I came to this thinking about my prior work, or not intuitively. Initially, I came thinking about the earned income tax credit, that as you have more cash on hand, you'll be able to kind of have better housing affordability. And that, given sort of what I would say are revealed preferences from the earned income tax credit and the Social Security studies, people will move out, right? So they won't want to be in doubled up housing living arrangements. So that would be like one potential effect. On the flip side, people double up for a lot of different reasons. And so, you might move in with your grandma because you have a health problem, or maybe they have a health problem and you need to take care of them, right? And so if that's kind of what's going on, then I wouldn't necessarily think that this cash would impact doubling up. And then there's some new work that Mariana Morm and I have that actually looks at doubling up during the pandemic. We were focused on the 2020 year. We find that about an excess 500,000 kids lived in doubled up households, but that by 2021, things have kind of reverted back to normal trends. And so there doesn't seem to be sort of some surplus in doubling up that's kind of going kind of descriptively, at least by 2021. And then on the last way we might think about that is actually, so only the families with kids are going to kind of do better kind of economically, right? You're maybe embedded in networks of lots of people who don't have children, or some people that don't have children. We might actually think that having that money on hand might make you a little bit more economically secure. So perhaps you're going to bring people into your household. So we're not really sure which direction to sort of anticipate. I mean, I already told you we find nothing, but beforehand we weren't sure. And then around partnership, I think also it's not so clear what we should expect in this population in particular. So, that we're a group of demographers, we probably thought about kind of family structure. And typically we might think that more economic stability leads to more partnership, right? Or kind of better relationship quality. So we might think that partnerships would be more stable when people get more money. That said, the people in our study, only 30% of them are partnered. And also we know kind of from the literature more broadly, they're more likely to be in cohabiting relationships because of marriage rates are very low amongst very low income populations. And so if we're thinking about that, we know also that the literature between the link between income and cohabitation suggests that sort of that relationship, one, is weaker, and two, that there's actually a lot of people who cohabit because of economic reasons. So they kind of mistimed their cohabitation. And what I mean by that, by mistiming, is sort of they move in before they would necessarily want to move in together, but because they want to pool resources. And in that case, we might think actually you get this cash on hand and then people move out. There might be actually an opportunity to kind of get rid of that partner that you were living with and maybe you don't want to be with because you moved in together for economic reasons. There's also literature called not to be mistaken with the living apart together, but the living together apart, where you live together, but you've broken up because you can't afford to actually move out, right? So in that context, we might then also expect a reduction in partners. Yeah.
This program, as it was, I think, enacted was temporary.
Yes.
And I mean, sometimes the way you're talking about it ignores that fact.
I am
So,
ignoring it. Yeah.
Yeah. So I'm wondering how
that might impact.
What?
How that might then impact our
Yeah.
estimates.
Yes.
Yeah. So that's what I'm about to talk about.
Oh, okay.
You were like previewing where I was going. So the cash is short. So there's two things, right? One is it's short-lived. It's only 6 months. So when we might think about kind of estimates, maybe we think of these as the lower bound estimates, right? So that if it had continued for longer, perhaps we would see different effects. But what Charlie's asking about, nope, not Charlie. Yes.
Yes.
John. Charlie, John, sorry, John. Don Bound, I know who you are. Just had a do brain fart. So what you were asking about was that it is actually, people knew that it was temporary. I actually don't know. It was enacted as a temporary credit. And I think that maybe some of us in this room would know that it was temporary, but it's not the same. But I don't think that these families in the study necessarily knew, in part because there were debates in Congress literally up until December of 2021 as to whether or not we were going to enact, continue this credit. In fact, if you would have asked one of my co-authors, Luke Schaefer, he would have said, we're definitely going to renew this, even as late as December. Yeah.
Only some people believe that the political branch is different than anybody would participate.
Wait, I can't, I'm sorry.
I think people should have rationally thought the chances they get reviewed is small. Because we would have anticipated Republicans would actually win the House, which they did. And we would anticipate they wouldn't support a renewal, which they did. And so I actually think, and none of that was certain, but I don't understand how anybody could have said they expected to be renewed in this country.
So I think it depends on who you are, right? And how politically aware you are. If at the time, the reason it didn't get extended was Manchin, who is a Democrat. So it actually hadn't, right? So, okay, fine. He's a Democrat. But my point is that there was a point where what you're talking about is true. It happens, but it actually not in this context. It could have been passed if he hadn't stopped it. But I also think that we're not talking about folks that are really kind of myopically focused on what's going on in Congress kind of writ large. And the reason I'm going to say this is that we asked them in January, what are you going to do now that the credit is ending? And a huge number of them in their open-ended response were like, what? Now, we don't have a quantifiable what, so that's why it's not on this slide, but my sense is that actually people didn't realize it was ending. But even if they did, even if they knew, I think that there's actually for this population, very low income, housing is very fluid. People move in and out of these living arrangements. I don't want you to think of perhaps your middle to upper class kind of economic situation where you are you live in one place and then you move maybe on an annual basis. That would be a lot. Folks in these households are moving a lot more often than that, kind of typically. And also I really want you to think about what $500 means. So in this sample, we're going to be thinking about you're getting $500 a month. That doesn't seem like a lot of money. That's the average child tax credit. It's going to be a 60% increase in monthly income. So the kinds of decisions and the behavioral responses we might observe in this population in particular might be different than slightly higher up the economic distribution. Maybe why. So what are we going to do? We partnered with this company called Propel, and they make an app that's called the Providers app. And in this app, essentially what it is, it's for food stamp users. So people on SNAP, the Supplemental Nutrition Assistance Programs, they can essentially go to this app and track their food stamps. Before this app existed, they would have had to call the food stamp providers. There's a number of reasons why this might be really useful. One, you can see if your food stamps have actually landed in your account, right? Or you can see how much more money you have left while you're actually out shopping. Nearly 5 million SNAP users at the time were using this app, which represented a quarter of all SNAP users in the country. So it's big. And they were running a monthly survey, and essentially we partnered with them and we're allowed to add some questions to their survey to ask about how things were going during the pandemic. This is what it looks like. So basically you go to this app and you can see kind of what's left in your account. And here you can see these little kind of information pieces. That's where they would put a banner saying, we're inviting you to take a survey. And essentially what they ask is they say, we'd love for you to help provide feedback to improve both our services and inform advocates on how to support their community. On average, the survey took about 11 minutes to take. They were not compensated. So, who are these people that are taking these surveys? This is going to be the question that you have. And I'm going to show you some data, but I'm going to do the best I can to kind of try and understand these groups. So what are we going to do? We're going to have these monthly surveys. We're going to have 2 pre-periods because the way the tax credit worked is they were released on the 15th of the month. So we're going to be in the field the 1st to the 14th of each month. We're going to have both June and July as sort of pre-periods before the first credit goes out in July. And we're going to go through January. And in January, we're going to ask them about the December credit that they received. Now, One of the questions I always get is, why are we not looking at the lump sum payment? Because only half the credit was paid out over the monthly business. And why not the lump sum? I have concerns about the lump sum payment for a number of reasons. One, we were actually interested in the child tax credit. So what other payments are going to happen at tax time? All the other payments. So the earned income tax credit, if you're eligible for that. They also temporarily expanded the child independent care credit, which also was made refundable for 1 year. If you missed a stimulus payment, you're also going to get that in that payment. So there's a lot of things going on there. So I don't know how you can disentangle just the child tax credit. But actually in our study, we asked them if they filed taxes starting in January and then again in February. And we know that almost 20% of them have filed taxes. Now you may be saying you can't file taxes that early, and you're right. But you can go to a tax preparer and get an advance refund. And actually many people in our study population do that. And so we don't have a post period that's kind of after the end of the child tax credit, because it's all kind of mushy with this lump sum. And also we don't think that we can kind of really identify cleanly what the lump sum effect is. So we're not going to look at that. We are also going to limit our study sample to families with children. So at least one child under the age of 18. We're going to have about 20,000 or 20,500 families in our study. And we're going to limit, and we are limited because that's who in our study population is, our families with low income. I want you to think of them as all having incomes below 25,000. The mean is about $10,000 a year at the household level, not individual, not earnings. And as I already mentioned, you can think of this as a 60% increase in monthly income. Okay, because you're going to say who's taking these surveys, I'm going to show you how they compare to the American Community Survey, the current population survey, and the SNAP quality control data. What's SNAP quality control data? It's an administrative extract that the USDA provides of SNAP recipients every year. It's also from 2019. Okay, so how do they compare? And this is, we don't have a lot of demographic characteristics that are consistent across these 4 different data sets, but you can see some of them here. Providers are the people in our study sample. And then for the American Community Survey, we limit to those under 100% of poverty. And we also look at those who are SNAP recipients. So SNAP, you can technically get up to 130% of poverty. So they're not exactly the same, but we were kind of interested in thinking about these as sort of just poor families. And then the SNAP quality control data, and then the CPS, we're going to use the March supplement, the ASAC. Okay, so you can see there, on average, I think this is pretty decently comparable across most of these. There's a lot of different studies here. Which one's the right one? What you can see here is there are some differences, right? So in providers, we're going to have more Black respondents. We're actually going to look much more similar to the SNAP quality control data than the American Community Survey or the CPS. And we're also going to have more women. But again, we're going to be much more similar to the SNAP data than we are relative to other data sets. And so I'm going to kind of use the SNAP data as kind of a benchmark, and hopefully you're thinking, okay, I'm going to think about this as kind of generalizable to roughly to families on SNAP and maybe poor families. But just to give you a little more sense of really who these families are, this is monthly household earnings. And what you can see is that 23% have no earnings at all. So these are very poor families. And then if we look at labor force participation, only 42% of our study sample is employed. And we're already in the later part of the 2021, right? So this isn't the time of the pandemic when everybody was really just not able to kind of leave their homes. And then another 29 are unemployed. So, and then 29 are out of labor force. And so these respondents are not typically eligible for the child tax credit. So this is kind of why we're thinking about this group as kind of disproportionately impacted. So we asked folks in our study sample how much they got, if they got the child tax credit, and how much they received. About 66% reported getting the credit, and they said that they got about $500 on average. Now, why did more people not get the credit? There's actually a variety of reasons why you might not get the credit that are sort of legit, right? So like you could say, I don't want the monthly credit and I just want it as a lump sum. You might actually, it's based on your having filed a tax return. And so they're going to use past tax returns to determine whether or not the child is in the household. As I just talked about, there's a lot of fluidity in these households. And so where the child is, that might be not accurately reflected if they're going to get sort of a different amount perhaps than what they say, or maybe they didn't have the credit, maybe they didn't have the kid. So you have to have the kid in your house for at least half the year in order to claim them on your taxes. You know, someone might claim them on another tax. There's a lot of reasons why this might happen. That said, Kathy and I have some additional work where in January, we asked people, did you ever get the credit? in the past, you know, and all of this expense, and we find that about 80% of families at least got the credit one time. So while we find this sort of 66% in any given month, it's actually a little bit higher over time. As I mentioned, about 30% are living with a partner. You can see 14% are in some form of a doubled up household. And then nearly 57, more than half of our sample says that they owe past rent to a mortgage. Just to give you a sense, in the household pulse survey, which is run by the census, that figure for the national sample was something like 11%, right? So these folks are having a lot more difficulty than kind of the average household. And then in terms of condition on if they do owe back owed rent, they owe close to $1,500 in back owed rent. Okay, this is for my students because I invited them to come. So in our ideal experiment, right, what we would do is we'd be able to kind of randomly assign, if we're thinking about the thought experiment, randomly assign some families to get the credit and some families not to get the credit, and then you could just compare across of those. But of course, child tax credit receipt is not randomly assigned, and in fact, technically, 90% of all families with kids were eligible to get this credit, but also the kind who actually gets the credit is correlated with the things that we care about, right? So if you think about receipt of the credit, it's not random, it's correlated with measures of economic well-being, which I would assume are also, you know, kind of linked with housing affordability. So if you look here on this side in the yellow bars, this is telling you who basically self-reports of whether or not they got the child tax credit by employment status, and you can see quite clearly receipt of the child tax credit is correlated with employment, right? It's also, in some of our work Kathy and I have done, has found that it is really one of the strongest predictors of receipt is whether or not you filed your taxes. There were portals where people could go in and file their taxes and make changes. There was a lot of issues with those portals, and a lot of people had a hard time actually getting kind of everything sorted out. Okay. So we're going to take a parameterized difference in difference approach. We're going to compare families. So for this 2 pre-periods before the expansion to the 6 observations post, we're going to rely on variation in the size of the child tax credit by the number of children and the ages of the children. So we're essentially going to parameterize the child tax credit by calculating the amount that you would get based on what you reported on how many kids you have in the household and what the ages of those children are. So you may have expected me to do a traditional pre-post difference in difference, which would compare families with kids to families without kids. We don't do that. Well, it turns out families without kids are really different from families with kids. This is probably something you would know kind of right off the bat. That said, there's a lot of studies that do this. And why? Okay, because they have pre-trends that actually work. And so they're saying it's fine, we have these pre-trends and they can observe this. We don't have pre-trends that work. When we look in the pre-trends, some of our variables look like they're fine and maybe you would buy it, and other ones you definitely wouldn't buy it. So we just immediately said, this is not the right way to do this. I also think that there are many reasons why this is not a good comparison group beyond the pre-trends, right? The people who don't have kids are much older, much more white, at least in our sample, and that's actually kind of true actually outside of our sample as well. And there are also lots of policies that are going on right now that differentially impact families with kids and families without kids. We're going to control for some of these things, right? Also, like we're going to control for SNAP, PEBT, which is the pandemic electronic benefit that basically gave payments to kids that were going to school and so forth, which might differentially impact by the ages of the child. But when we're also going to control for unemployment insurance and things like that. But I still think we can't kind of control away the differences between families with kids and families without kids. So this is the formal model. Like I said, we're going to impute the amount of the child tax credit with month fixed effects, state fixed effects, a number of month state contextual factors. And then we're going to also have number of child fixed effects. So what's left? We're going to be comparing families with kids, 2 kids before, families with 2 kids after. What the variation is going to be in the age structure, right? So some are going to have 2 kids under 6, some are going to have 1 kid under and 1 over, and some are going to have 2. That's the variation that we're exploiting in this study. Okay. We're going to produce 2 estimates, an intent to treat estimate, where we're going to assume everybody actually got it. I just told you that only 66% said that they got the credit, but we think it's more. So I'm going to do both. I'm going to do an intent to treat and the local average treatment effect, or the treatment on the treated. We're going to instrument for receipt using whether or not you said you got the credit. I want you to think of, I'm going to show you both results, but I think the probably true effect is somewhere in between, right? The late is going to overestimate the impact because there are going to be some folks who got the credit who aren't going to say they got the credit. Okay, should I pause there? Do you have questions? Yeah.
Yeah, how are you thinking about the fact that more kids means more benefit, but also more, consumption needs?
We're going to control for the number of children in the household and household size.
Sorry.
We have controls for household size and for number of children.
Oh, that's for leveraging variation of the benefit level that was determined by the number of children.
Yes, I know, this is really confusing. What we're actually leveraging is variation in the age structure,
Oh, just the age structure.
just the age structure in this paper. We have done both in others, yeah.
You've got the same families before and after.
No, it's not,
You
it's
don't.
not a panel study, it's a repeated cross section.
And they're independent cross sections and you
They're
can't
independent.
identify the,
Like you can't do any sample twice.
yeah.
I think you can't. They open them to different
I was
ranges.
wondering why you didn't have family fixed specs.
Oh, yeah, no family fixed specs because it's not a panel. They're repeated cross sections, but I should say that on the slide. Perhaps someone else got into the sample twice, but I'd be really surprised if that happened because they open them to different segments of the population. So what do we find? These are marginal effects, but I'm going to say that there's a lot of robustness checks that we do in our study that I think these are all kind of pointing in the same direction. So if you look here, this is whether or not these are the point estimates on the effect of a $100 child increase in the child tax credit. So these are just the beta coefficients that are plotted or graphed. But remember, most people are getting an average of $500, right? So you would think about multiplying these times 5. And we can see here, this green is the intent to treat, and this is the late. So somewhere in between here, we can see that people are like less likely, these are percentage point changes, reporting kind of a reduction in moving because they can't afford their rent. They're also less likely to report that they owe back the rent. And then this is the log of the amount that they report owing in back rent. Oops. And then if we look at living arrangements, so people say, we ask them, did your living arrangement change? And they say, yes. So more likely to have a change in their living situation. And what we can see here in particular, you can see, right, the total number of people in the household declines. And what the change that's occurring is not in doubling up, like I thought maybe it would. Actually, rather, we find this sort of reduction in the likelihood of living with a partner. So we also, as I mentioned, we look at differences by race ethnicity, and we do this in part because of the sort of what I was talking about, sort of who qualifies, sort of differentially, certain groups, populations are actually benefiting more than others in terms of eligibility for the credit. And what you can see here is this what I've plotted instead of the beta coefficient is actually just the percent change, because kind of who's in each of these groups is a little bit different, just to put them in the same terms. And so what you can think about here, or without knowing what the means are, what you can see here is that actually the reduction in moving because of difficulty affording rent is really being driven by Black households. But we do see, and now this estimate is not statistically significant for Hispanic households, but I think that's in part because we have less power. We have a much smaller sample for Hispanics in our sample study, but you can see kind of both groups are reporting less owed rent and also the amount of back owed rent that for in terms of for both Black and Hispanic households. And then in terms of living arrangements, what we see is that kind of this living situation change is really driven by both the Hispanic and white households, but not that much is going on really for the Black households. And you can see that the reduction, again, it's not statistically significant for the Hispanics, but certainly suggestive of the direction of the effect for both for Hispanic and white households in terms of less likely to live with a partner. I mean, these are pointed, so, in the kind of maybe more doubling up, if anything, but the total number of people are declining. So we also cut the sample by earnings. I've just told you that it's $2,500. For $25,000 is like everyone's earnings below that. So why would we think that it would matter? Well, in part, we were thinking about that very bottom group. So the people with zero earnings or very low earnings who are just not eligible for the current child tax credit, are sort of, again, disproportionately kind of benefiting from this change. And what we observe here when we do that here, so it's essentially the 50th percentile, actually. So in monthly earnings below $500, you're in the bottom 50th percentile of our study sample. And what you can see here, so this is essentially 100% increase in your monthly income from the child tax credit. You can see that while these are, the difficulty in moving rent is really driven by the by this bottom group. Same thing in terms of the decline in pass owed rent and the declines in the amount due. It's really driven by the very low, very low income households. And then when we look at the living arrangement changes, we don't see the pattern is not the same. We do see that sort of there's an increase in your likelihood of experiencing across both groups in terms of some kind of change. Both groups for living with a partner. And then we have this interesting kind of difference in terms of the directional effect of doubling up, which is null in the full sample because it's going in different directions. Once we cut our sample like this, and so this is where we're thinking about the idea that the slightly higher income folks within our sample might be a little bit more economically stable kind of already, then getting this extra cash maybe also allows them to bring in some other people into their household. But I don't want to make too much of a big deal about this. It's just like, well, multiple hypothesis testing, one little tiny estimate here. Okay, we do a lot of different things in the paper. We, do things like exclude August. We exclude January because maybe people thought or they knew that the tax credit was ending so that they would respond differently. We also restrict adjustment, and when we do that, actually our point estimates become more significant. It's robust to controlling for a lot of different things. We've heard, we have a number of papers on this sort of through the review process. People want us to control away all the variation. So they want us to control for the number of children under the age of 6. We actually do this in the study where we include a control, just sort of trying to test different sensitivities. It actually doesn't seem to matter. The point estimates are pretty robust. Doing things like controlling for COVID rates, because this is when the big Omicron spike was happening. None of these things really seem to matter. We also do something where we reweight our estimates to look more like the ACS, the CPS, and SNAP quality control data. Because I don't know which one's right in this model, but I mean, it's robust. They're robust to these sorts of reweighting. We tend to find stronger reductions in the people who are not willing to become, more robustly statistically significant when we reweight, and weaker ones in terms of the reductions in partnership. In part because when we reweight the data, we're actually weighting up partnership to more married people who we observe in the kind of more representative, like the ACS or the census surveys. We did also an extension. So this is a question, we're thinking of cutting this from the paper. It's sort of too much going on. But we did an extension where we used cost burdens from the American Community Survey, where we estimated kind of at the state level what the average cost burden would be. It's not ideal state level, but that's what we have in our data, or states. And so what we then find is essentially in states that have lower cost burdens, so the bottom 50th percentile of cost burdens, we find bigger effects. And this to us tells us that basically the $500 goes further in states that don't cost as much money as in the states where, it's really costly. It doesn't do enough, essentially. And then we also look at different types of doubling up. So, whether or not we see effects on multi-generational households, or we find nothing. We basically find no effects across all the different forms of doubling up. So, I'm showing you $100 units here. The average credit was 500. So like those point estimates are pretty small, but if you multiply them, they're not so small. I think what we find essentially is that they're less likely to move due to financial hardships, and they're less likely to have back of debts. And they're also pushing partners out of the household. So we do a back of the envelope calculation. And what we do is we can actually look at the household income of households with a partner and households without a partner. And it turns out the average difference is $530. So when we saw that, right, so these partners are not bringing in a lot of extra income. This is kind of one thing to take away. The second thing to take away is that, to me, it makes me feel a little bit better about the idea that $500 might even induce you to actually push out a partner at all, when essentially the $500 is almost perfect replacement for the partner's income. But as we were just talking about, right, the credit was short-lived. Not everyone got it. It was also provided during a pandemic and during a very inflationary period. So again, I think all of these kind of probably bias our estimates downward, especially in terms of the inflation, right? Then it's not going to have as much effect as we might expect, but perhaps it limits the generalizability of the findings of the study. And that's all I have. So.
Recall correctly from your very first slide, there were a couple of studies that found no effects.
Yeah. They do a pre-post difference in difference. So I have, there's a couple of things. I think it's different because of our study population. So we're much focused on a group that really disproportionately benefits in a way that most of these other studies are using like nationally representative samples. And the other thing is most of them are focused, some of them as extensions do that take the approach that we take and still find ill effects as well. But some of it is that I don't also totally trust all of what's going on when we do the comparisons of families with kids to families without kids in some of the studies. Some of them are great, don't get me wrong. I'm not trying to, diss on my friends and colleagues. But I think that mostly it's probably study population, but some of it's methods.
I wanted to ask a leading question from the demographer, so, or just survey people in the room. So what are you most worried about in terms of possible non-representativeness of the folks that you're relying on here in the data?
So I'm not that worried that I believe my comparisons. I mean, I think that we just kept looking at data, and I think that it's representative of SNAP users. I think what I don't know is what the response rate is, because I don't have that information. And so would this is probably a terrible response rate. I genuinely don't know. And so then who is it that's taking these surveys and how are they different from other people? That's probably true. So the response rates are going to be pretty good in the American Community Survey, right? And so if on average they look like the American Community Survey people, maybe that's going to make me feel a little bit better about who was in my study sample. I think this is a problem with survey research in general. We don't know who it is. Like, I think we know that people who take surveys are different from people who don't. And so, and how would that then impact our effects? I don't know.
And this survey followed them anywhere, right? So even if they were sort of fluidly different housing and so forth, since they're getting it on the app.
Right, so we're not following them over time.
But if their address changes.
If their address is changing, it's on their app. Their SNAP benefits are going to
no matter
stay
what
on there
they
unless
find
they
out.
lose their SNAP benefits, right? In which case they will probably still be on the app, frankly.
Yeah.
And there are people who are in our study sample who are not currently receiving SNAP. And why would they go to the app? There are coupons in this app, actually. So there's a number of reasons why they like these apps. The app is actually really useful to low-income families.
I'm thinking about the partners leaving the household. So was there a question about who received the payment or whether it went into a joint account or like?
No, but we know that the person who's taking the survey got the payment.
Got the payment. Okay, so that's mostly women.
It's mostly women.
Yeah.
Yeah.
Okay.
Yeah. And,
So
and
like,
the
I don't
single
know.
men aren't going to get the credit, right?
Yeah.
Unless they.
So the partners who were leaving were single men who are not like the fathers of the children.
I don't know for sure they're not the fathers.
Yeah.
We didn't unfortunately ask if they're cohabiting partners or not, but my guess is they're largely cohabiting partners.
Yeah, it's really interesting.
Yeah. But fewer people who get SNAP fewer married people are getting SNAP in general, right? Yeah.
So in counting families, how does the eligibility work? So if there's a child living with their biological mother and a guy who is not married to the woman, but provides most of the support for the child, who gets?
But it's gonna go to the mother.
That goes to the mother.
And the father in that case, or the social father, is not going to count. Now, but technically for SNAP eligibility, actually all related people in the household do count. So if grandma's in that household, she could count. But you can make the argument that you don't share household resources and then have her not count in terms of your eligibility. There's a number of ways in which they do that, and they're apparently like they can. SNAP can come into your house and check. You have like your food in different cabinets and things like that. The extent to which that occurs, I don't think is that common.
Where I'm going was partnering and unpartnering would not affect mother's eligibility for this group.
Not if they're not married. Right. But if they are married, then it would matter. But you would have to get divorced, right, for it to affect your credit eligibility.
I was trying to think about the scalability of this approach and how it will work, and also, so there are two issues that I was thinking. One is, do you think the effects are linear in the amount? So as the amount goes up, you will spend, or because in terms of housing, it seems like you need a threshold often, a threshold money to be able to do something different, right?
Right.
So that suggests maybe there are strongly nonlinear effects. And the other thing is, so in a sense, if the amount is larger, maybe the effects are going to be much larger than what you are
Right, so if it wasn't
reporting
just
because,
$500.
yeah.
Right, which is what the earned income tax credit is closer to a $3,000 credit where we find bigger.
Right, but it will be substantially bigger because of this non-linearity in what you can do versus house.
Yeah,
Like-
well, right, no, I hear what you're saying. I mean, unfortunately, we can't do that because we're leveraging really small changes, right? Yeah, but I think you're correct in thinking about housing, which would then, so you could again, with this would bias us downward, right? In terms of what our point estimates are. Because if we think that you get a bigger lump sum transfer would probably have larger effects on housing. Yeah.
And on that direction, I'm definitely have made this argument about a lot of the support for housing benefiting because there is not an expansion in supply.
Right.
And a lot of it benefiting the landlords often. And so that's a question about the scalability of this is.
You're wondering about what land lords might capture from the child
Yeah,
tax
so they
credit.
may, they may be capturing more money, but people stay basically the same in terms of the housing.
Sure, that can happen. I mean, assuming that people are mainly using their credit on housing. I mean, they're obviously using it on all sorts of things. And we know that from just the descriptive statistics, especially at the very low end, people are just paying their basic bills, right? So, you know, it's not quite as bad as like when Matt Desmond at the end of his book says, let's give everybody more housing vouchers, which is just going to flood the market with housing vouchers, which can only be used on housing, right? And then you might think about the distortionary effects being pretty large in that context. Whereas here, sure, there's going to be, I mean, people are blaming the child tax credit for inflation. I don't know the extent to which that's true, but it's certainly, I think it's going to be less impactful when we give people cash because there's so much more fungibility around it than in the context of just I mean, that's my argument. I don't know. We've never done either. So really, but I mean, that would be, yeah.
Did you look at comparisons across the months? Like, was there more of the household composition change in the later months when they've been getting this for a few months, or?
We did. I don't remember. I don't think we found anything because it was like a lot of noise and we just don't have, you know, we have very imprecise estimates. So we have a paper on mental health actually where we do it by month. And we observe greater effects at the end of the months, but we didn't see that here when we did that. And so we just threw it away, to be honest. And I don't remember exactly. Yeah.
I'm curious about, you mentioned that there was an open-ended question about plans for after the credit expires, and said that a lot of people didn't know about it. Outside of those people, was there any significant findings of like what people's plans were once the credit expired?
Yeah, so we asked this question. Unfortunately, we didn't think to ask them, like, did you know the question? Like, did you know that the credit was, this is just that, like, I went through these coding these, 2,000 responses and noticed that came up a lot. So that was a very unscientific observation that I made, but it's the best I can do. But what did we find is people were basically saying that they were going to get another job. They were going to have to scrimp, was basically I was going to just have to make it happen, and so there was just a lot of people like, it's going to suck and I'm going to just have to deal with it, is essentially how people said that they were going to make it to me.
Two-part question. So was Provision already doing some sort of survey that you added questions to, or was this like entirely your survey?
So providers actually has a whole, they were running a monthly survey anyway, because they were really interested in how people are doing and so they've been tracking for food security over a long time. So in some of our other work, we're using, we added some questions on material hardship and we added like the validated 2-item food insecurity scale and so forth, which is not in this. These items are actually all things that they were already included in their studies that we didn't have. So just by chance, that's what we were doing. We have only very limited control over adjusting the survey or having things worded that we wish they were worded. But you know what? I had access to like a huge sample of low-income families here, so it's a trade-off.
I mean, that's why there was no incentive for your survey. That was like, since
It was run by them, and we just basically I had worked with them as a prior work. And so I had a relationship with them, and when they realized, they were really excited about the child tax credit and they wanted to see if it was benefiting their population. And so we got the chance to essentially just sort of join forces. But it was implemented in in March, and by July, the first payment went out, and so we really didn't have a lot of time to do much of anything, really in terms of thinking about this. And yeah, there were no incentives because they were already running a study, and I had no money to pay incentives, so it was sort of like, yeah, it's a dividend on this, but you know, yeah.
People use the app for non-food stamp spending and actually make the payment.
People use the app for non-food stamp, so they don't use the app to pay, it just tracks how much they have in their bank account left.
So the app tracks how much is in the account, but not what money leaving the account was used to buy.
They
Okay,
actually track practically nothing about their users. So to give kudos to Propel, they want to really be, they're very like, they don't want to, you know, take too much information from the people. So basically the only information they have is like if they're on staff and they're in the state that they live in. And then Propel has some information on like app usage, right? The stuff that they care about, like how often people open the app, or like, you know, if you make it this green, do people use it more? The stuff that user interface folks care about. But from our perspective as researchers, it would have been lovely to have a lot more information, but they really just aren't capturing much. They do have some information in here on Catherine Richards' committee. No, anyone know what I'm talking about? She's a joint economics policy student. She has some information on the spend down and the rate at which people spend, but we don't have that information because it's not connected to their survey.
How did you form the relationship with the providers, app people in the first place?
That's a great question. So we, during the pandemic, Luke Schaefer, Brian Jacob, and myself, and Catherine Richard, we ran a randomized controlled trial for Give Directly. And Give Directly is a nonprofit organization that basically just gives the money. That's what they do. And so they had formed a relationship with Propel to use basically this population to give away some money during the pandemic. And we ran two RCTs actually with this. And so we developed a relationship over that time period with them. And so, yeah, it's just serendipity. I don't have a good way to tell you how to find something like this.
Good to talk to you.
I mean, I am doing another study, but again, they don't have a lot of bandwidth for extra kind of research and time. And so, you know, I've hopefully also been of some use to them over the years. And so, you know, we have a relationship that's, you know, kind of developed over time.
I think in your first slide, your first result slide on the income arrangements, you had, you know, the effects for doubling up and for a partner leaving, and it seems like there were much larger effects on reduction of the number of people in the household.
Yeah.
Do you know, like, if it's not partners leaving and it's not changes doubling up, like, you know who the people are that are leaving, that are causing a reduction in the household, or do you have like
Yeah. A question that Kathy and I have muddled about a bunch of times. I don't have a great answer to that, unfortunately. I don't really know what part of it is the way, like, right, this is in numbers, and so I'm trying to figure out, the coefficients are not in the same scale.
Right.
Right.
I guess I'm just trying to think it's like a
There's some
meaningful
heterogeneity, right?
reduction.
So we have some differences also in sort of all these other people, and so I think it's being driven by some stuff that's not coming up as significant in doubling up. But there's something going on here, like a reduction in maybe non-kin or other relatives that are not partners that are leaving in certain contexts. Same thing is here too, right? Although there's an increase here, so who knows? I don't know what the answer is.
Yeah.
I don't know what the answer is.
I'm sorry, I'm gonna have to cut off this wonderful conversation. I really appreciate everybody who attended on Zoom. There was a large crowd and in the room, so enjoy any leftovers in the back, and let's give Natasha a really great round of applause.